Hey everyone, I hope you guys are good and the last few videos treated you guys well and you kind of understand or you can see the light. But basically now in the previous video or in the most recent video, we looked at the VET discussion question, how to approach it. Remember, your type, timing, and value are like your go-to. Anything else is just added on, right? And yeah, let mark application be your guidance, right? So now we're going to have a look at how we actually calculate the numbers. So we're going to play with the numbers right now, or rather discuss the numbers, right? So the main thing is, remember the structure that I gave you in the first few parts of the video, where I said normally we have 4 columns that we need to be focused on, and that really helps us a lot. The first column would be the description, which is where you'd put the type of transaction we're dealing with. The second part would be the reasoning, where we either show a section reference or we actually give like a 1 sentence reason. Don't write a long sentence, it must be really brief. And then the third column would be your calculation column, where you jot down all the calculations that you did. And remember, it's very important that even if a calculation does not result into an amount that you can put in the amount column, which is the fourth column, you still need to show that calculation and you show that 0 in the amount column. It's very important. It's a nil amount, yes. Or maybe it didn't start off as a nil amount, but you need to show everything and you need to give a reason for why something is 0. Or sometimes your calculation will give you that reason, even if it was an inclusion, right? Likely, as the years go by, I think after second year, there's no need for you to speak on why something is included. We are more, or the marker really wants to know why something is excluded from the taxable income or the VAT or whatever the case may be. So wherever we have a calculation, we really need reasons for the nil amounts, and we don't really care much for the reasons for why something was included, because it shows your work. Yes, you included it, good. Why, even if it was a section D, it's for it to be section D, but it's a paragraph E, then that's you and your business. But as long as you included it, perfect. There's no reason for that. But the most important thing is, why is something 0, right? Because the taxman doesn't really care to know why something was included, because it's good for them. They need to get the money. But once something is excluded, then they start to worry. Okay, so you need to be very brief and specific to why something resulted in a nil amount or whatever the case may be. For example, a transaction is exempt because it's a financial service. So that's it. Even in income tax, you can say something is excluded from gross income because it is capital in nature, therefore not included, right? Remember to say this amount is not included in gross income because it is capital in nature. You don't just say capital in nature. No. Even if it's a deduction, this is no section 11A applies because it is capital in nature. That's your brief reasonings. And remember, with VAT, we're dealing with, most of the time, it's 2-month periods, right? So every 2 months, it can either be even months or odd months. So you really need to be mindful of which period are you dealing with in terms of VAT. Even if it's year end that we used to, normally it would be Feb and Jan. So you need to be mindful of that. And also the transactions that occur outside of that specific tax VAT period, it can also result in nil amounts, right? It can either, for example, if you're dealing with the January and February VAT period, anything before Jan is excluded, and anything after Feb is also excluded, and that results in a nil amount. And that you can just say it is outside of the VAT period. That's it. Okay. Now the integration. This is where VAT is integrated with the Income Tax Act. And basically, it is governed by the Section 23 Cap C that requires that the cost or market value of a specific transaction be reduced by the input tax claimed, right? Remember, input tax is claimed by the buyer and output tax is levied by the seller. So input, think buyer. We are happy for input. Whereas output, we're not so happy because we are paying it over. So output is mainly affected by the seller. And remember that output tax, there's no apportioning, right? So your 80% or 75%, your 95%, they only affect input claimed. And another important thing is input amount is not always equal to the cost multiplied by the tax fraction. So meaning sometimes it can be based on the open market value, and chances are maybe the open market value is less or more than the cost. So therefore, it might result in a great reduction in terms of that. So be mindful of that. Sometimes they equal, so it can be the same thing. So do not be tempted to deduct or to rush off to the tax fraction, even if it's like an income tax question and they say VAT is included. Normally, the one thing we do is that we'll take the amount that we have and say 100 over 115. Sometimes that is not the case. You still need to think about the actual VAT implications of that specific transaction in order for you to deduct the correct input tax, right? So as the third note says that when applying Section 23 Cap C, you need to think about how the transaction would have been treated from the VAT perspective, right? So I know it has happened to me so many times. I've been tempted a lot to basically just use 100 over 115. In certain transactions, it does not work that way, and you need to be mindful of that, okay? The same logic also applies for output tax. So the difficult sections would be indemnity payments, and that is in relation to like your insurances and stuff like that, right? So we have short-term contracts, and normally it relates to a loss incurred in the course of an enterprise, and it includes payments to third parties, right? So indemnity payments, like I said, think short-term insurance type of thing. Normally like your car insurance, your phone insurance, equipment, whatever the case may be, and obviously third-party payments. So if it affects another party getting hurt and you need to make a payment out to that person, that is your indemnity payments. It is a deemed supply, so that is our type. What is our type? Deemed supply. Timing, when the payment is received. And what is our value of supply? It is the consideration that we have received, and of course it is the tax fraction multiplied by the tax fraction. And in this case, this would be our input tax, because we receive this money from our insurance, and then we obviously need to pay it over, whatever the case may be. But the fact that we received it, that means we need to claim input. And that would be, if there's a need to apportion, we apportion. Okay, cool. And then we have right of use of a motor vehicle, right? So this is not really difficult. You just need to make sure that you understand the scenario and you're able to apply the information in the scenario, right? The difference between deemed market value, retail market value, open market value, or just market value, right? You just need to differentiate those sections or those amounts and understand what each mean, so that you can get to the correct amount that you need to use to actually cover this, right? So make sure you read over, understand, and memorize the steps of this calculation. Very easy steps, because the VAT section is all over the place. It's really important that you try and memorize this calculation, because yeah, it will make your life easy. And once you get the correct amount, there's no need to stress. Okay, so all of the steps are in the slides. The hardest part is the deductions, right? So just learn three different scenarios relating to the types of deductions, and you should be fine. And just make your little notes in your logbooks to remember what triggers the different types of deductions. Okay, so fringe benefits, which is covered in Section 18(3) of the VAT Act. And the use of a motor vehicle, these are the reductions, right? So these deductions are allowed against monthly consideration. Because remember, the amount that we get at the end is a monthly consideration. And therefore, if the employee does not pay consideration and the employee bears the full cost of repairs and maintenance, remember to deduct only 85 francs per month. Or if the employee pays consideration for the right of use and the employer claimed input tax on the acquisition, then deduct all the amounts paid by the employee, excluding portions relating to finance charges, and fuel costs, right? And if the employee pays consideration for the right of use and the employer's input tax was denied, then we're going to deduct all the amounts paid by the employee, excluding the portions relating to finance charges, fuel, and those costs that relate to fixed costs, right? So it's either we deduct 85 rands, and this is because employee pays for the cost of repairs and maintenance, and the employee does not pay anything to the employer. So consideration is in relation to what the employee is paying to the employer. So in the first case, the employee does not need to be paying anything to the employer, and they are in charge of paying for repairs and maintenance. That's when we deduct the 85 rands per month. In the second section, the employee does pay the employer, and basically the vehicle was not input denied. Therefore, the employee can deduct all costs borne by them, excluding finance and fuel costs. Whereas if the employee pays consideration and there was denied input on the vehicle, then the employee can deduct all the amounts except for finance, fuel, and fixed costs. So that's what you need to know about the deductions. Just try to figure out, in one aspect, the employee does not pay anything, and they have maintenance and repairs. It's a stable amount of 85 rands, whereas the employee pays. So that's the first point, and then you're going to split it into two: denied input or claimed input. And when you claim the input, you deduct everything except for finance and fuel. When there is denied input, you claim everything except for finance, fuel, and fixed costs. Okay, so in the next video, we'll look over the exam technique.